The Rebel Capitalist Show.
So talking about price inflation, let's talk about
Yeah.
the Aussie housing market. Because I think that's just a fascinating kind of case study. And
Yeah.
it's something that I think Americans should look at because we might be going down that same path to a certain degree. And I'm not talking about just the housing market. I'm talking about putting all of our economic eggs in one basket and just trying to kick that can down the road, and how that kind of hollows out the manufacturing base, and it hollows out the fundamental power and the structural soundness of an economy.
Yeah, I mean, that's what happened in Australia. Australia has expensive house prices, and like all else, the manufacturing sector has been not completely destroyed. There's still a reasonable but very small manufacturing sector. When you look at the complexity of Australia's manufacturing sector, it's roughly equivalent to Senegal.
Yeah, well,
Okay, it can't produce a lot of things. It doesn't have a lot of the intermediate goods you need for various forms of production. So it's a hollowed out system, as you say, because all the money has gone into house prices.
right.
Now, America, certainly in the aftermath of COVID, and given the massive disruptions on the supply chain with China, you need companies to be investing. The companies to be investing, they've got to have low levels of private debt. And at the moment, they've got astronomical levels of private debt. And that's the danger. With that high level of private debt, you're unlikely to see the investment you need to rebuild the manufacturing sector so you can make stuff in America. So unless you reduce the level of corporate debt, you're in a pickle.
Yeah, but see, then what they do, they don't think that through. The central planners, let's say, the politicians, the central bankers,
Yeah.
and they just say, okay, let's just double down on housing. Or in the United
Yeah.
States, let's just double down on the stock market. Let's just double down on the stock market. And they keep doubling down
Yeah.
until the entire economy is built around the stock market, or the entire economy is built around housing. And at some point, that house of cards has to come down. And when it does, you have no economy left.
Yeah, and that's the great danger. We've got into financial engineering so much we've forgotten about real engineering. And
Yeah.
real engineering,
Well said,
real
well
engineering,
said.
real engineering requires physical monetary investment. And if the banks aren't providing the money for it, and the corporate sector is massively in debt as it is now, then you're not going to see much of that investment taking place. Or if it does, it's much more fragile, because if you don't get the return you expect, then you're going to be going bankrupt, which is the last thing you want to have, a massive corporations doing right now. And I don't know, actually, I might just do a bit of a screen share again, if I can.
Sure.
Here, George,
Yeah.
just quickly, just
Yeah.
to illustrate the level of private debt. This is including government debt as well, but this is the recent situation for America for private debt, starting from back in the 1950s, up to a peak in 2008, now rising again because of COVID. Government debt is actually less than private debt, even given the amount it's increased in under COVID. But
Right.
the interesting one for me is actually the blue line. That's corporate debt. And you can see corporate debt was down. I've actually just traced it and check and see what the level was back then. Corporate debt was about 20%, 22% of GDP, 25% of GDP to 30% in the immediate aftermath of the Second World War. And then it's risen quite substantially and is now at 85% of GDP. Now, I wanted to get it back to about the sort of level back over here, about the 40% level. And at that level, it's possible to imagine people borrowing money to build factories,
Yeah.
which is what you need.
Yeah,
So
Yeah,
you've got
when
to
you're
reduce
talking
the
about
debt.
when you're talking about the corporate debt, though, Steve, the first thing that comes to my mind is going back to the Federal Reserve, and I go straight back to March 2020, where the Fed comes in and basically puts a backstop to the entire corporate debt market. They come in and through special purpose vehicles, they not only buy corporate debt, but they buy junk debt. They buy junk corporate debt. So then what do the corporations do? They just borrow more. They say, well, shoot, if the Fed's going to come in and backstop the market to where interest rates are at historic lows, I'm going to borrow as much money as I possibly can. So you you have this perverse incentive process that's set up by the Fed and all these unintended consequences.
And that's why you've got to go beyond just the idea of a modern debt jubilee that I spoke about earlier. I also want to bring in various reforms to the nature of the stock market that mean that it actually promotes capital formation, not leverage and capital destruction, which is what's happening right now. So I'd like, 99% of the trades on the market or more are secondary share sales. They're not raising capital for anybody. IPOs are trivial as part of the overall market. So I would want to change shares, the ownership of shares, so that when a share was initially issued, it would last forever, as shares do now. But after a number of sales, you could vary how many sales were allowed, it would have a 50-year life. And at that point, anybody who bought the share was buying an annuity, and you'd be a fool to pay a speculative price for an annuity. So something like that makes it more attractive for companies to issue shares on the market and get IPOs and initial capital coming in that way, but unattractive to gamble and speculate on the shares over the long term.
Yeah. I think I've got such a huge edge coming into the investment space as a retired entrepreneur, because I was, I was never a big business owner, but I had several small and kind of mid-sized businesses. Yeah. And I always use the example of when I would look at potentially buying a McDonald's franchise. Mm-hmm. And I never want, if the business broker came to me and gave me the P&L, let's say, in the balance sheet, I would never think to myself, well, what can I sell this McDonald's for in 3 months?
No, that's right.
It never even it would be laughable. I sit there and I look and I say, okay, well, what's the bottom line? All right, this little McDonald's is producing $100,000 worth of cash a year. They're asking $1 million. So how much do I need to borrow to get that done? So what's my cash return going to be? How can I improve the business? How can I grow it over time? Because I want to keep this as I'm buying a business, for heaven's sakes. I'm not just buying a piece of paper that I want to sell in 3 months for a higher price to a greater fool. And I think we've just completely lost that concept.
We have, and that's financial capital has taken over, and mainstream economics has played a major role in letting that happen by all the mythological stuff they write about how the stock market functions, efficient market hypothesis we spoke about earlier. So I want to see genuine industrial capitalism come back, and that's where when you invest, as you say, you won't sell it in 3 months' time. There's a wonderful mathematical economist, a mathematician actually, who decided to take economics, called John Blatt, and he talked about what happens on the share market as not being investment, but placement. You're placing a bet.
Yeah, right.
Okay?
Yeah.
Okay. And therefore, you bets, you want to turn them over as fast as possible. That's not investment. Investment is where you have a long-term commitment, and you're expecting to make profit out of cash flow, not over the price appreciation in the short term. And Keynes said the same thing. He said there's no such thing as liquidity for an economy. If you're invested in steel, then you're invested in steel. You can't suddenly be invested in steel one day and tulips the next. And yet the mentality we've got is as if you can do that, and as if that would be a good thing. And both are false.
Yeah.